Hi, Bill Hunter with Evergreen Home Loans. Quick market update as we're going into February 2025. January was a blur. So fast. Got some snow here in Sandpoint. Hope you're all well out there. So this week was pretty quiet for mortgage rates. And we went into this week thinking that there was going to be a lot more volatility than there ended up being. We had the Federal Reserve first policy decision of the year, along with the inflation reading to end out 2024, and that reading was on Friday. So as expected, the Fed decided not to move their short-term rate. That was expected. And the inflation reading, specifically the personal consumption expenditure index, PCE, which is the Fed's favored gauge of inflation, came in line with expectations as well. And as we know, the market loves when things come in at expectation. So we didn't see much volatility. For note, the PCE index came in at 2.6% for the rise for the entire year. And the core PCE, which takes out food and energy, which is the one that the Fed likes the most, came in at 2.8%. So we know, and you've probably heard a million times, that the Fed is shooting for a 2% inflation, and that is the gauge that they're trying to get there, now at 2.8%. So not there yet. And therefore, what we're seeing as far as predictions for the year is only 2 Fed rate cuts, probably 2 quarter-point cuts for the year. This number, if you've been tracking this, changes all the time just based on what's going on in the market. But that's the gauge, or that's the prediction as the market sees it now. It'll be really interesting to see when predictions actually come true. But that's the expectation today. So here's a snapshot. I'll share here just a snapshot of average national rates as we close out the week. Very similar. We're just over, you can see it's just over 7% for the 30-year fixed conventional rate. We're seeing that very similar here locally too. Got to be careful with mortgage rates when you're searching them. I had several conversations with clients this week about looking at rates, and gosh, some of those rate quotes out there, just seeing 2.5% origination to go along with some of the rate quotes out there, which is awfully dang expensive for a rate that isn't historically low. I also want to in this video, if that's all you needed was just a snapshot of kind of what happened this week and where rates are, then you can stop the video now. If you want a little deeper dive into some more of what we're expecting going into 2025, and I'm recapping some conversations, quite a few conversations that I had with agents, referral partners over the course of January, then listen on. History is a great teacher. And what we've been consistently telling people as far as expectations for 2025 is that it's likely to be very similar to 2024. So I'm going to give you just a snapshot here are the last 12 months. This is from basically the end of January of 2024 through the end of January of 2025. And what you can see there is a high in the mid 7s last spring, and we almost got to 6%. We're in the low 6s for that really short period of time, kind of in that September, right before the Fed rate cuts happened, was the best rates of the year, kind of in that low 6s. Wouldn't be surprised at all if we were to fast forward a year from now or look back on this video a year from now and see something very similar for 2025. And this is what we've been telling people. We're going to see a range somewhere like that. I hope that the low is actually in the 5s. I hope we see some more 5s or see back to the 5s for 2025. But the wise words, hope is not a strategy, certainly come to mind. I think we just have to be okay with rates in the 6s right now, just over 7, just kind of being in that range. What we've been hearing from especially people who've been in the market now for a while, One of our first closings this year was with clients we've been working with for 3 years, and we're hearing this with some consistency, is this is just kind of the normal. It's been, the rates went up above 6% in the middle of 2022, if you can believe it. We're basically above that all of 23, all of 24, now at 7% in 25. And for the people that have been in the market for a while, this is normal. The 3% rates of 3 years ago are gone. Nobody thinks that we're going to be there again anytime soon or ever. And we're seeing that it's just more normal, right? The average buyer out there, while they don't like 7% rates or rates in the sixes, even, they know this is kind of what we're up against. And what I think we're going to see in 2025 is more people come off of the sidelines, because waiting around for rates to get lower is just not a great strategy. So one other thing to share, had this conversation quite a bit, obviously through the election. We shared this just a little bit before, but there are 3 things that I just wanted to highlight that the Trump administration could have an impact, things that they could do that could have an impact on rates. One is just a lower cost of energy, which would have a downward impact probably on inflation. Lower inflation is good for mortgage rates. So if we have more domestic oil and gas production, that's probably good for oil and gasoline pricing, which would lead to lower inflation and could lead to lower rates. It's not direct, but certainly could have an impact. The other is a cut in government spending. Trump has already done quite a bit in this range, or is really trying to do a lot in this area. Doge, being the big headline with Elon Musk and the things that they're doing there. Cutting government spending is great for mortgage rates. Government spending is inflationary, and also mortgage-backed security bonds, which is really what directly impacts mortgage rates, compete with treasury bonds. And every time the federal government spends a dollar that they don't have, they have to issue a bond for it and borrow that money. And if there are fewer treasury bonds, that means there's less supply, which means that without going into a ton of detail, is good for rates. So cuts in government spending, good for rates. Last one, and this is big in the headlines right now, is tariffs. So this is a real crapshoot, because who knows what's actually going to happen, how they're going to be implemented. But one thought there, and you've probably seen this in the news, is that it could lead to higher cost of goods for some things that we import from Mexico, from China, from Canada, those 3 being specific in the news this week. That higher cost of goods, by definition, is inflationary. That, just taken by itself, could be inflationary, and that would be bad for rates. So we'll see how all those things pan out. A little bit longer message today, but lots to share there. And these are just lots of conversations that we're having with clients and with referral partners. And I wanted to share those things with you so you can be up to speed on what's kind of going on out there. As always, we're a phone call, email, text message away. Have any questions, want to get into a deeper dive on anything, and we're here to help. We're in this together. Hope you guys have a great weekend and are off to a great start in 2025, and we'll talk soon. Thanks.